Hi, I am Dhawal.G.Dhanani and I will explain how you can analyze a bank before investing in its stock. Since a bank's functioning is completely different than a regular manufacturing company, an investor will need to understand the various terms used in the banking sector in order to understand its business. And since functioning of banks is completely different than other businesses, their financial statements are also prepared different. But before starting on as to how the banks work, I would like to show you chart of two famous Indian banks with their respective CAGR returns. So you can see Bank A has given a CAGR of 14%, whereas Bank B has given a negative CAGR of 9% in a period of 5 years. Now throughout my presentation, I would explain you broad parameters which led to their deviation in performances. And at the end of my presentation, I would surely reveal the names of both the banks. So here's a brief on how banks work. Banks give loans and earn interest, which is the revenue source for a bank. They accept deposits and pay interest, which is a cost for them. And then by deducting interest paid from interest earned, banks make profit. So the basic principle for a bank is that the interest earned on loans given should be more than interest paid on deposits taken. Now the banking sector is the backbone of the economy, which also goes through its own phases of ups and downs. When everything is rosy, lending and borrowings boom, which in turn leads to healthy growth in loan book, whereas when the going gets tough, defaults rises, and this leads to increase in bad assets, which is nothing but bad loans. Now banks in India are divided into public sector banks and private sector banks. Private banks includes banks like Kotak Mahindra Bank, Axis Bank, HDFC Bank, ICICI Bank and many others. While public sector banks, where the bank's major shareholder is Government of India, comprises of State Bank of India, Bank of Baroda, Punjab National Banks and many others. Now moving on to bank's annual report. First, we will have to understand how to analyze the profit and loss statement. Interest income. This figure is to be extracted from the head income and under that interest earned. This figure would include everything which banks earns as interest. So which are majorly interest and discount on advances and bills, income from investments, interest on balances with RBI and other interbank funds. So CAGR of interest earned is calculated, which can also be compared with CAGR of peer banks. And now we see that interest earned by Bank A rose at CAGR of 15.35%, whereas interest earned by our Bank B rose at a CAGR of 9.77% in last 5 years. Next is interest expenses. So bank's major expense is interest expense, and this figure is to be taken from line item interest expended. Moving on, net interest income, which is also known as NII. This needs to be calculated by deducting interest expended from interest income. Hence, this is nothing but difference between interest earned from lending activity to its customers and interest paid to various account holders on their deposits. CAGR of NII is to be calculated to analyze the performance and the trend of the bank. And when we see NII of Bank A, it has given a CAGR of close to 16 and 17%. And when we compare this with Bank B's NII, it has grown at a CAGR of close to 10%. A higher CAGR growth of in NII is better for a bank, and you must look as if CAGR is consistent over years. A decline in NII should raise a red flag. Coming on to net interest margin, which is also known as NIMS. This is expressed in terms of percentage and is provided by banks in their annual report or press release post quarterly results. This can be calculated by dividing net interest income to interest-bearing assets. Interest-bearing assets includes cash and balance with Reserve Bank of India, balances with bank, and money at call and short notice, investments and advances, which all are to be taken from asset side of balance sheet. The higher the NIM is the better, but it is of utmost important to check the trends of NIM on a YOY basis as well as on a quarter-on-quarter basis. NIM should be consistent throughout last few years. So now we can see banks A since last 5 years has continued to maintain their NIM at 4.30%, whereas Bank B has not been able to consistent enough in maintaining their NIMs. Coming on to cost to income ratio. This helps in assessing the profitability of the bank. This is a ratio of operating expense to operating income, which is interest earned plus other income. Now if we see the ratio is rising over years, it means that the cost is rising at a higher rate than income. Hence, a lower ratio suggests higher profitability. Now we see that Bank A's cost to income ratio is on a declining trend and now stands at 39.70% as on March 31, 2019. Whereas if we compare this with Bank B's cost to income ratio, it is showing an increasing trend and stands at 55.70%. Coming on to net profit. Net profit is to be compared with previous years to understand the trend of profitability of the business. Now Bank A's net profit was clocked at a CAGR of 15.59%, whereas Bank B has shown fluctuation in profitability and reported a net loss of rupees 6,547 odd crores in financial year 2017. Coming on to return on asset, it is expressed in terms of percentage. Return on asset indicates how profitability a bank is relative to its total assets. It also suggests how efficiently it is using its asset to generate earnings. Now this is simply calculated by dividing net profit by total assets. Now moving on to balance sheet. Advances. Banks' primary earnings come from their assets. Now this is nothing but loans given to customers and hence it is considered as asset in the business and is one of the most important metrics in stock analysis. Increase in advances and the rate of increase will inform us how the bank is growing its business. We can see that advances for Bank A grew at a CAGR of 17% over the last 5 years, whereas Bank B's advances grew at a CAGR of close to 11% over the past 5 years. Coming on to deposits, bank accept deposits in form of term deposits as well as savings and current account. Banks lends out most of its deposits which it receives, and accordingly, deposits form the major source of funds for a bank. Analyzing deposits numbers would imply how comfortable the bank is able to acquire funds to lend. We see that deposits of Bank A grew at a CAGR of close to 15.5% over the last 5 years, and the deposit base of Bank B grew at a CAGR of 13% over past 5 years. Coming on to current account and savings account ratio, which is also known as CASA ratio. This is a ratio of deposits in the current and saving account to total deposit. A higher CASA ratio means higher portion of deposits of a bank has come from current and savings deposit, which is generally a cheaper source of funding as banks provide low interest rates on savings account, which is generally between 2 to 3%, and no interest on current account deposits. High CASA ratio indicates lower cost of funds and in turn better NIM. Banks A's CASA ratio stand at 42%, which means that nearly 43% of total deposits are from current and savings account, and similarly Banks B's CASA ratio stand at 45.74%. Coming on to gross non-performing asset, which is known as GNPA. Now a loan becomes a non-performing when it ceases to generate interest income for the bank. Now GNPA are the total loan classified by bank's management as non-performing. Gross NPA ratio is the ratio of gross non-performing assets to gross advances. Now both the ratio and absolute amount can be extracted from financial statement at the end of statement of profit and loss. This absolute amount as well as the ratio should be checked in order to determine the asset quality of the bank. On similar lines, net non-performing asset is a ratio of net non-performing asset to net advances. Again, both the ratio and the absolute amount can be extracted from the financial statement at the end of statement of profit and loss. Now it is important to check the trends of NPA, which would determine the asset quality of bank. Bank A's NPA is seen slightly rising but is now pegged at 0.40%, which is the best asset quality in the whole Indian banking industry. Now on the other hand, Bank B's asset quality is unstable over years. We see a stark difference in their NPAs. Coming on to provision coverage ratio. Provision coverage ratio indicates the extent which a bank has provided for the weaker part of a loan portfolio. Now this ratio is calculated as total provision balance of the bank to the gross non-performing asset. So when a provision coverage ratio is high, it suggests that additional provision are to be made by a bank in coming years would be relatively low. Now, Bank A's provision coverage ratio stand at 71.36%, whereas Bank B's PCR stands at 78.73%. Now coming on to capital adequacy ratio. Now, capital adequacy ratio is also known as capital to risk weighted asset ratio. Capital adequacy ratio is the ratio of bank's capital to aggregate risk-weighted assets. This ratio is decided by central bank, which in India is the Reserve Bank of India, in order to prevent commercial banks from taking excess leverage. The Basel III norms stipulates a capital to risk-weighted asset of 8%. Now, these norms were introduced to set a common standards for banks across countries, which was implemented post the financial crisis of 2008, which is also known as Lehman Brothers crisis, which acts as a buffer during difficult times. But as per RBI norms in force, Indian scheduled commercial banks are required to maintain CAR of 9%, while Indian public sector banks are emphasized to maintain a CAR of 12%. Now, CAR is nothing but summation of Tier 1 capital plus Tier 2 capital divided by risk-weighted assets. Now, Tier 1 capital consists of equity capital, statutory reserves plus disclosed reserves. Now, Tier 1 capital is used to absorb losses and does not require a bank to cease operation. Tier 2 capital comprises of retained earnings, unaudited reserves, general loss reserves, and hybrid debt capital instruments. This capital absorbs losses in the event of a company winding up or liquidating. Now, risk-weighted assets. Now, these are the fund-based assets such as cash, loans, investment, and other assets. Now, the degrees of credit risk expressed as percentage weights are assigned by a bank's regulator to such assets. CRAR of Bank A is 17.10% and Bank B's CRAR stands at 12.72%. Now, some people must have already identified the name of the banks. And for those who haven't, any guesses? Yes, you are right. Bank A, which gave CAGR of 14% over the 5 years, is the private sector lender HDFC Bank, and Bank B, which has given a negative CAGR of 8% over 5 years, is the largest and the oldest bank of India, State Bank of India. Generally, there is a stark difference between private sector bank and public sector bank. Major one being, public sector banks usually have higher NPAs of 2% and above, while NPA of private sector banks are within the range of 0-2%. This is a major distinguishing factor between their valuation multiples too. On price to book value perspective, public banks are usually trading at a multiple below 1x, while private sector bank trades in the range of 1 to 4 times their book value. Now, these are broadly covers the important terms to understand bank's financial statements. Along with these, there are some other factors that you must consider before picking bank stock. Regulator's stance. Banking industry is highly regulated by RBI. Any decision regarding various aspects like maintenance of CRR, which is cash reserve ratio, statutory liquidity ratio, and repo rates affects banking business. Next is economic slowdown. Now, loan business is understood as one that broadly imitates India's GDP mix by catering to consumption theme. Now, any impact on economic growth and interest rate scenarios may directly affect demand of loans. Peers. This is the utmost important to compare ratio with peer banks and the industry average, which would aid in deciding the position of bank with respect to its competitors. Portfolio. Study the business portfolio of the bank to get a better and a clear idea of its business model. Now, these broadly cover the important terms to understand a bank's financials. Along with these, there are some other factors that you must consider before picking a banking stock. Banking industry is highly regulated by RBI. Any decision regarding various aspects like maintenance of cash reserve ratio, that is CRR, statutory liquidity ratio, which is SLR, and repo rates affects banking business. Loan business is understood as the one broadly imitating India's GDP mix by catering to consumption theme. Now, any impact on economic growth and interest rate scenarios may directly affect demand for loans. It is utmost important to compare ratios with peer banks and the industry average, which would aid in deciding the position of the bank with respect to its peer competitors. Now study the business portfolio of bank to get a better and clear idea of the business model. The loan mix of corporate and retail loans can be a differentiator of performance between two banks. And friends, if I sum up, it is very important to check all the above parameters while investing your hard-earned money in any banking stock. The major one being trends of NII, profitability, trends of bad loan formation, which now you know is called NPA, and of course lastly capital adequacy ratio and return ratios, the major one being return on equity of the bank. That's all for now. Thank you so much, friends.